My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
Hey gang, welcome back. We got a really special treat here today for you. We've got Jason Hartman, who is very, very well known in the real estate space. And Jason's been in the business for decades. Jason is a very accomplished real estate entrepreneur. He's a trainer. He's a coach. He is probably the longest running real estate podcast guy I know of, starting his show way back in 2005, before I think podcasts were hardly even invented.
That's true.
And Jason, we're going to be talking about something really interesting today, and that is kind of debunking some of the, doomsday predictions a lot of gurus are talking about with real estate, and talking about how people can actually create wealth with inflation. So Jason, welcome to the show. Great to have you.
Yeah. Hey, thanks, Dave. It's great to be here. And, to your point, I mean, the cost of money tripled 3 years ago, and it's made housing extremely unaffordable. And so, even before that, I mean, there's always people saying that the sky is falling. That's been that way throughout history. It's just part of human nature.
Yeah.
And, for forever before the Industrial Revolution, the world was basically marked by scarcity. Okay. And when the Industrial Revolution came along, it made things and economic abundance and, it just made things a lot better, right? And, we learned to produce goods and also services after that in a really efficient manner. And so, our minds are kind of trained through, thousands and thousands of years of evolution to look for negative, right? Because that's what kept us alive.
The fight or flight response, basically.
Yeah. Well,
that's what the news harps on, and that's what the news kind of feeds into as well.
Yeah, there's an old saying in the newspaper business: if it bleeds, it leads, right?
Exactly.
And so our minds were designed to look for negativity, and that was a survival skill. That's probably why most of us are here today, is because our ancestors were very aware of negativity, of threats, and that kept us alive. So that's great. But the problem is that all changed around the Industrial Revolution, and now the technological revolution even changed more.
Faster.
We need to be looking for opportunities, okay? And so there's all these doomers out there who say the market's going to crash, and they've just been wrong over and over again. They really started cranking up the volume on their doomsday predictions 3 years ago when the interest rates went up. And let me just tell you the fundamental mistake they made, Dave. This was just a huge mistake. And you can see why they made the mistake if you analyze it. What they looked at, there's about 140 million homes in the United States.
Okay.
And before the rates went up and we had the fastest interest rate increases in history, before that, we were selling close to 6 million homes per year, give or take. Okay. And that was a pretty good clip, right? There was a lot of activity, a lot of home sales. Everybody in real estate was getting rich, and everybody in the escrow business, the mortgage business, the title business, they were all making lots of money. And, then when people buy a house, they tend to buy appliances, furniture, and window coverings and all sorts of other stuff. So they were all making money, and, it's all good, right? All these ripples through the economy. And when rates went up and prices were already high because we'd had so much appreciation, they said, hey, housing affordability is at a 4-decade low. It's terrible. Nobody can afford a house, so the market's going to crash. And, that was only one side of the equation. And they were right about housing affordability for sure. That was absolutely true. And it's still true. It's terrible. Housing is very unaffordable. We all know that. But here's a mistake they made. What they didn't count on is so sales volume went down by about 2 million per year. Okay. And now we have lower volume, and everybody's been complaining. There's not enough activity, not enough sales. Sales are low. Okay. But what they what they were counting was only the new buyers entering the market. They weren't considering the people that controlled the housing stock, okay? And that was 140 million potential sellers, okay? Those people were super comfortable. Their houses were and still are extremely affordable. They have 25% of the country has a rate at or below 3%. 65% of the country has a rate at or below 4%. So they have very cheap mortgages. 42% of the country has no mortgage at all. They own their house free to clear. So
42%.
Yeah.
Wow, that's huge.
And here's the thing. If you want to be a doomer and you want to be right and you want to predict a crash, there is one ingredient you absolutely must have. You cannot have a real estate crash without this. That ingredient is tens of millions of distressed homeowners that become millions of distressed home sellers. We have the complete opposite. People aren't distressed at all. The foreclosure rates are actually declining. Okay. Like nobody is distressed virtually. I mean, it's like such a small number. It's insignificant.
Well, they're distressed in multifamily, but not in single family.
Yeah. That's
a bit different
in
than
an office space. They're distressed as well, but I'm talking about single family homes. That's what I'm talking about. Okay.
Yeah.
And so without distress on the part of the people that own the stock of housing, they're not going to sell it, and they're just not motivated.
There's no motivation. There's no pay. So what's the big difference between the situation now and the situation in 07, 08?
Oh my God, it's vastly different. Now, listen, there's an old saying, the famous last words of any investor that's about to get hammered is this time it's different. Okay. We all need to be aware of that psychology, right?
Please.
But it really is extremely different. I mean, that was a once in 7 decades occurrence, the Great Recession, okay? And before that, the worst time we had was the Great Depression, okay, in the 30s, of course. So I'll just show you a couple of charts here, and this will really bring this to light.
Yeah, so if you guys are listening to this on iTunes, you can watch this on our YouTube channel for sure.
Yeah, and I'll try and explain it for audio-only listeners too. So what I'm showing now is a total housing inventory chart that goes back to 1980. Goes back a long time. And then it goes up to July of this year, okay? And you see here that inventory is actually very low. In fact, right now, it's the lowest it's been since the mid-90s. Okay. I mean, granted, it was low during the COVID era too. Okay. So, I'm taking that out. But in the long view, before the COVID era, when we had the lowest inventory ever, we'd have to go back to the mid-90s to have inventory this low. Okay. But always ask yourself, Dave, when you're looking at a chart like this, what is the chart not saying? What is it not telling me? What is excluded from this chart? Well, population growth and household formation growth. Those two things are not in here. So when you compare the inventory now to 1995, we have a much higher population and many more households than we had in 1995, and even than we had during the COVID era. So these inventory numbers per capita are extremely low. There is very little housing inventory. We have a pretty significant housing shortage. And so that's one thing to consider.
Yeah, so that's not taking population into account, basically. That's just numbers of houses on the market.
Absolutely. If you looked at population, you'd think, my gosh, there's just nothing for sale.
Yeah.
I just want to distinguish that the more important metric than population is actually household formation. It's how many households are there versus how much population. Now, population usually leads to more households, but it's not exactly the same. And here's one way it's really different. Nowadays, we have the smallest number of people per household that we've ever had in history. So you actually need more houses because there's more single people. I mean, marriage is just not a popular thing anymore.
So it's not what people are assuming with kids not being able to leave home, kids moving back in with their parents.
Yeah.
Immigrant families coming in with 7 generations under one roof kind of thing. That's not the norm.
Well, I mean, some of that certainly happens, but on average, the household size is smaller than it's ever been in history.
That's interesting.
Okay. I mean, we used to have, 4 or 5 people per household on average. Now we have like 1.5.
Wow.
Okay. So, it's dramatically. And look, you don't need to take my word for it. You just look around and think of all the people and how many people live alone versus with a partner or with kids or whatever.
Yeah. Yeah.
And so, so that's all. But when you look at appreciation, the appreciation has been very mild. In fact, it's kind of a snooze fest. Okay. I mean, this chart is not as current as a new chart I just grabbed earlier today. And it shows in the trailing 12 months, our year-over-year appreciation rate is 2.2%. Okay. Now, historically, we'd like to see about 6% appreciation to be sort of normal. Okay. During the COVID era, we saw dramatically more appreciation than that. But, the appreciation is just not exciting, right? The market is very muted. It's just kind of wondering what to do. It's like a standoff between buyers and sellers. The buyers do want to buy. There's tons of demand out there, but they're saying the prices are too high. The interest rates are too high. We're just not going to do it, Right. And so that's where we are. If you look at existing home sales, you see that volume is way down. I mean, this is why everybody in the business is complaining, but do not confuse volume with prices. Okay, prices and volume are two different things. There is the number of sales and the value of each home, right? And so prices have still been going up. In fact, it's amazing that you triple the cost of money, basically, right? Where interest rates went from, I know people with mortgages just about 2%. Okay.
Yeah.
But if you look at a 2.5% mortgage and that tripled, okay, 7.5 was there were lots of 7.5 rates, just in the very recent history here. And you triple the cost of money and the prices still rise.
It's mind-boggling, but it kind of gets back to what you're talking about initially. And that is, it's not the typical supply and demand situation because so many homeowners are perfectly comfortable with where they're at right now. Yeah. Like you mentioned, their homes are super affordable because 45% of them don't have a mortgage at all. So there's no mortgage expense. And a huge chunk of them have still very low locked in mortgage rates.
You got it. That's exactly right. So they're just not motivated to sell because if they sold and bought something else, or even if they sold and rented an equivalent house, it would cost them more.
Yeah.
Their deal is so good that they're just not giving it up. They are.
Doesn't even make sense for them to downsize.
No, I know. That's the amazing thing, right? Like a lot of retiring baby boomers would normally downsize. This has made the market kind of dysfunctional, okay? Because they normally would sell their big house, their empty nesters, they would downsize and then, go travel, right? That would be a very common thing. They'd get a condo or something, right? But now that's actually more expensive than just keeping their big house. Yeah, it's a really weird time we're in. Of course, we have lots of inflation in the market, and real estate is the best hedge against inflation in the world in multiple ways, not just the way most people think of it. And, time permitting, we could talk a little bit about that. As real estate investors, we get a giant share of people's income. And, if you think about it, if you look at the, one of the most successful companies the human race has ever known is Apple. Okay. Mm-hmm. And, I spend maybe $1,500, $2,000, I probably spend $2,000 a year with Apple, maybe a little more than that actually on average, because every couple of years I'll get a new laptop, every couple of years I'll get a new phone. I used to get a new phone every year, but you don't need to anymore because they're
subscribed to iTunes and then you're on Apple TV.
Yeah. Well, with all the, I wasn't even counting all the subscription fees, right? So good point. I spend more than that. Anyway, that is the most successful company in the world, right? Or, NVIDIA, you can argue it, whatever.
Yeah.
It changes. But Apple was the first one to make those incredible records. And the share of income Apple gets is nothing compared to the share of income we get as real estate investors. Think of it. Every month, the first 12 days of the month or so, that tenant is working to pay you, their landlord. Okay? That's if their rent to income ratio is like 33 to 40%. And in Miami, it's even higher. Miami, it's like 50% of people's income is housing cost or rent. So it's just crazy. So 12 days of that month, they're working to pay you as the investor 40% of the year. 146 days a year, they're working to pay the investor the rent on that house. So in terms of share of income, I mean, you can't do better than being a real estate investor. You're going to get the highest share of people's income that way.
No, that's a very interesting perspective to look at it. No, that makes a ton of sense.
Yeah.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Fascinating stuff, Jason. Yeah. So when you're talking with people that are either in the real estate market, they're real estate investors, or they're kind of sitting on the fence, what do you recommend to these people? Because a lot of people are scared of getting into the market. They think it's just overpriced, and it's hard to make properties cash flow these days, especially when we're talking about single family homes. So what kind of recommendations do you have for people?
Yeah, look, no question. I mean, no one can deny that it is very unaffordable. But just always remember that in every marketplace, there's always an equalizing force, okay? So if it's unaffordable for you, it's also unaffordable for the person who's renting now who wants to buy. Mm-hmm. So what are they going to do? That's going to push them into the renter pool and put upward pressure on rents as long as housing is unaffordable. When housing becomes more affordable, rents will actually soften, but prices will rise, okay? So you have this like two-sided equation as a real estate investor where you can make money either way, right? So say, for example, you're already an investor and you own properties now, right? Right now, you're going to push your rents as high as you can. Now, I do want to say something about that because we have a weird anomaly going on in the rental market too. You mentioned apartments earlier, multifamily, and those have been massively overbuilt. In fact, last year, we had the highest number of new apartment deliveries in the history of the country, okay? So that market got way out over its skis a few years ago. A lot of apartment owners and investors went broke, went into foreclosure, are trying to do loan workouts, modifications. The apartment syndicators have burned people. Their investors have lost money like crazy. There's lots of lawsuits on this, everybody knows. So, but here's the thing. These apartment units are now, they've been stealing some would-be single-family home tenants, okay? And they've been doing that for a few years now. And so what we're seeing the apartment market start to gain its footing again in terms of rents. Apartment rents are now actually rising again where they've been very soft for years. And so that supply is getting absorbed. Yeah. And, the number's a little gray, but I would predict that in the next, 6 months ish, that supply is going to be largely absorbed. And the apartment market is going to be very healthy again. It's just going to take a little time. It's been working its way out of it. And then you're going to see those rents go up a lot, and you're going to see the incentives disappear. They're already disappearing, and they're already rising, but, it's not hugely substantial yet.
Yeah.
And then what you'll see is single-family home rents rise much more because there is a lot of hidden upward pressure on rents and certainly prices, okay? The only dynamic that really changes the game is either you massively reduce the population, okay? Maybe we could have a plandemic. Maybe, mispronunciation was intentional, okay? That was about the biggest scam in human history right there. And we're forgetting about it too soon, I must say. But, we could also have deportations, right? Mm-hmm. And people die, certainly, and people are born, and, the cycle continues, right? And so, we reduce the population, and that lessens the demand, or we massively increase the supply. And there is no evidence that either of these things is going to happen. Okay. Yeah, there will be some deportations, but they're nothing compared to, for example, the Obama administration.
It's a drop in the
terrible
bucket.
job with deportations, to tell you the truth. Okay. I mean, it's a lot of news media, but in terms of numbers, it's not that significant. And the deportations, like if they happen in any significant way, so far they really haven't, they're going to affect really low end, mostly apartments. Okay. And leave some units vacant. And then those units will have to be filled by someone else. Okay. And then, we have supply, and the home building is actually slowing. Okay. If you follow the stock market, you know what's going on with home builder stocks. The home builders have got, more inventory than they want. They're cutting deals because they are not like the owners that I previously described. They do not have 30-year cheap fixed-rate mortgages. They do not own their houses free and clear. They have short-term expensive debt, and they need to move those properties. So I'll show you another chart that's really interesting.
Yeah, let's take a look.
Check this one out. This is fascinating. This is maybe the first time this has ever happened, at least in my memory, okay? Where existing homes cost more than new homes. That's weird. That's literally the title of this chart, right? It says that's weird. And it is weird. The reason is because the existing homeowners aren't motivated.
They are motivated. They don't want to sell.
Yeah, they've got too good a deal. And the new home builders are very motivated because they don't have the same deal. Okay? And so you've got to look at the motivation of the seller. Throughout history, as far as this chart goes back, which is to 1999, new homes were always more expensive. There was always a premium until right here, okay? And then it sort of met here in the COVID era, and then the new home prices started accelerating again, and now they're actually slightly lower, than the existing home prices. So you want to buy new or used? Used is more expensive. Isn't it odd?
Wow. All right. So what big broad strokes here, Jason? What are your recommendations to investors, single home type folks?
My recommendations is have the confidence to buy during the bad news cycle when everybody is afraid. I have seen this over and over throughout my career. I saw it in the 90s. I saw it in the 2000s. I saw it in the 2010s coming out of the Great Recession. And we're going to see it again right now. Look, it's just very simple math. There's just not enough houses. Okay. I mean, that equation, experts say that equation will shift in about 2032. We'll reach equilibrium. But for now, there's a shortage. And so you want to own and control assets that are in short supply. Period. That's always the key to success. Okay. Now, granted, you might have to buy that asset at a time when it's not exciting. When there's
or even what about negative cash flow?
Yeah. Well, negative cash flow is really it's really kind of a myth. I'll tell you why I say that.
Yeah.
Okay. Assume. First of all, you shouldn't buy properties with negative cash flow. Okay. That's the first thing I want to say. If you have negative cash flow, you're buying properties that are too expensive. You're buying in cyclical, expensive markets like the West Coast of the United States or all the way up where you are in Canada. Same thing, right? Very expensive markets. The northeastern markets, Massachusetts, or really particularly Boston, okay? Boston, Washington, D.C., New York City, those are all just way too expensive. L.A., San Francisco, don't buy in these kind of markets. Miami, way too expensive, okay? Don't buy in expensive markets. You've got to buy in markets that are inexpensive, linear markets, maybe hybrid markets. And I didn't explain what I mean about this. There's three types of markets: linear, cyclical, and hybrid. Okay. And the cyclical markets are the high-flying markets that are really expensive. And you're going to have negative cash flow in those markets, even with 25% down, because they don't make sense. You can't operate as an investor in those markets. They just don't work. Okay. Certainly Vancouver does not work for rental properties. Okay. Not even close. Toronto, none of those Canadian cities work. Okay. So buy in markets that are less expensive, And the cash flow does work. You will get some small positive cash flow with 20, 25% down. Okay. But why is negative cash flow a myth? Well, it's really a myth because if you paid for 100% of the investment, you would almost certainly have positive cash flow. Mm-hmm. Okay. When you buy stocks, bonds, mutual funds, cryptocurrency, gold, silver, any asset, okay, you pay cash for it. When you buy real estate, you finance it.
Yeah,
and that's one of the great things is that fantastic financing we have, okay, 30-year fixed rate mortgages in the United States.
Yeah, lucky guys.
So, if you put 100% down instead of 20% down, you're going to have tons of positive cash flow. So what you're really paying when you pay, say you had negative cash flow, which I would not buy a negative cash flow property. You heard me say that. Okay. Don't misunderstand what I'm saying. Okay.
Yeah.
Because if you buy in the good markets, you will have positive cash flow. It's just not as good as it used to be. I mean, the cash flow used to be way better than it is today. Here, it's just a minor amount of positive cash flow. Okay. But you're really paying your deferred down payment.
Mm.
That's what you're really doing. Okay. Because you didn't pay for the property yet. Like if you bought $100,000 worth of stocks, you're going to pay $100,000. If you buy $100,000 worth of real estate, you're going to pay $80,000 or you're going to pay $20,000. 25,000. Yeah.
Yeah.
Yeah. The down payment.
You're basically paying in the rest of your equity in the deal.
Yeah. Yeah. You didn't pay for the asset yet. You have to pay for it. Okay.
Yeah. No, that makes sense. Well, Jason, this is fascinating. I'm sure a lot of people are going to want to find out more about you and all the smart stuff that you have to say. Let us know a little bit about your podcast and let us know where you'd like people to connect with you, if you would.
Yeah. So like you said, I started podcasting 20 years ago when no one knew what a podcast was. It was funny. They used to have to explain how you access a podcast. What is that? I don't understand. Does that have something to do with my iPod?
Yeah.
Something that's the funniest questions. Now everybody knows, thankfully. So you just on any podcast platform, just type Jason Hartman on YouTube, Jason Hartman. And my main website is jasonhartman.com.
Doesn't get much easier than that. Jason, thanks very much for being on the show. This has been great.
Happy investing to you and your listeners.
All right, everybody, take care, and we will see you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.